We've just been tied up here talking about this big surprise of a number. I know you haven't had a chance to digest all of this, but does it tell you anything?
Well, I mean, I think it confirms that I feel very good about our policy approach, which is outcome-based monetary policy, which is let's actually allow the labor market to recover. Let's not just forecast that it's going to recover. Let's actually allow the labor market to recover, get back to what we call maximum employment, and get back to 2% inflation, and then we'd be in a position to talk about normalizing monetary policy. So as Chair Powell said a week ago, we've had one great jobs report. Let's not declare victory yet. Let's let the labor market heal, and then we can move from there.
Well, let me ask you the question John Farrow was just posing, and that is this because the weak hiring, is this because of the generous unemployment benefits, or is there something else going on?
Well, we hear all the same anecdotes. I was listening as I was checking my emails. I was listening and trying to process the report to your conversation. I think it's all of the things you talked about, Mike. Yes, of course, there are people who are on the sidelines who are getting generous unemployment, and they say, look, we know this is going to expire in 3 or 4 months. And I think and they're individually saying, we think the job market's going to be strong in 3 or 4 months, so why don't I just wait? We know that dynamic is there. We also know there are still massive childcare shortages that are holding back families from fully re-entering the workforce. That's disproportionately affecting women. And there are still a lot of people who are nervous about the virus, who maybe have not yet been vaccinated or who would need to get back on a mass transit in order to get to their job. And they're nervous about getting onto a crowded bus or getting onto a crowded subway. So I think there are a number of factors, but most of these factors should work themselves out over the next few months if the vaccinations continue, if the variants don't flare back up again. That's why I feel pretty confident that most of the pricing pressures that we're going to see are, in fact, going to be transitory, and we can get something back to a full economy, in the foreseeable future.
Well, I guess the word to describe the folks on Wall Street this morning with this number is gobsmacked, but you don't seem to be. You're not surprised.
Well, it's not that I forecast this, certainly not at all. But this is a highly uncertain environment that we're in. This is not the financial crisis that we experienced, so it's going to be a different recovery. This is a healthcare crisis, and how the American people respond. It was not simply about lockdowns that led to the economic downturn a year ago. We locked ourselves down as Americans because we were scared. We were nervous. I certainly haven't been out to the movies in a year or a year and a half. I'm for the first time taking my family on a plane tomorrow because my wife and I have been vaccinated. And so a lot of this is about individuals feeling safe to go back to normal, to get back on the buses, to get back on the airplanes. And how do we get there so that the vast majority of Americans feel safe again? I do think it's going to take time, and there are going to be ups and downs.
Do you think it's going to take significantly higher wages to attract workers? Are we going to see kind of a wage push here?
I mean, to be honest with you, I hope so. I hope we see employers step up. That was one of the things that was extraordinary about the last recovery. It took 10 years to return to something like maximum employment. And I'm not even sure that we quite got there before the pandemic hit. And it was only in the last few years of the recovery, after many years of businesses complaining that they couldn't find workers, only in the last couple of years did we finally see wages start to pick up, especially for those lowest income workers. Businesses will do anything they can do to try to meet their labor needs, and the last thing they want to do is raise wages. And so if we can get them to say, you know what, I raise my prices for every other input into my business, maybe I ought to pay fair market wages for my labor. I hope that process happens more quickly. We can draw people back in, return to something like maximum employment, and then really drive this economy.
I read a story this morning, an analysis this morning ahead of the payrolls report. It said this jobs number is going to be bad news for Joe Biden because it's going to make the case we don't need more stimulus. Do you think the fact that we get this low hiring level makes a case for more fiscal help?
Well, I think there's a lot in the pipeline from obviously the CARES Act and the Recovery Act that was passed. That's very large. That's still working its way, still getting out there. And so personally, I think that combined with monetary policy is probably going to be enough to restore and get through this pandemic and get to something like full employment or maximum employment and get the economy recovered. Now, I know the administration and Congress are debating other fiscal measures for longer-term economic competitiveness, and I think those are important debates to have. But in terms of just bridging the downturn from the pandemic, from the COVID crisis, I think there's a lot of fiscal stimulus still in the pipeline, and monetary policy is still, on full throttle to try to get us through this. And then, Congress and the administration can debate their longer-term priorities.
Speaking of monetary policy on full throttle, last night the Fed warned that elevated risk appetite is raising risks of what your report euphemistically called a repricing event. Many on Wall Street blame you for that. They say you're no longer taking away the punch bowl, but you've become the bartender. What's your reaction to that?
Well, I haven't done the math on how many Americans are still out of work. As of yesterday, the number in my head was around 8.5 million Americans, roughly, call it 8 million, out of work who were working before the pandemic. And the labor force has grown, or the population has grown since then. So it's probably closer to 9 or 10 million who want to work and should be working who are out of work. So for Wall Street, my friends on Wall Street, and I have a lot of them, I hear from them all the time complaining about the Fed's policies that are mucking up their trading strategies. I have zero sympathy, because there are still 8 to 10 million Americans who want to work, who ought to be working, and we need to rebuild this labor market and put them back to work. And then at that point, there will be plenty of time to normalize monetary policy. And if we're wrong, if these inflation surprises are not transitory but end up being more persistent, we have the tools to deal with that. We have the tools to tighten monetary policy to keep inflation in check. I'm not worried about that. What I am worried about is not having another 10-year recovery for our labor market. That's devastating to millions of Americans, and we need to put them back to work much more quickly.
Yet the question a lot of people ask is, do you still need to do $120 billion a month, or would less get you the same result that you're getting now?
I would say this. Quantitative easing is an inexact science. And what we're doing right now, I think, is supporting certainly the housing market, supporting financial markets in generally, keeping the yield curve lower, keeping the 10-year down, which bleeds through into all sorts of other different interest rates across the economy. So we're providing a lot of support to accelerate that recovery. Could somebody argue, instead of 120, it should be 110? Sure, we could have that debate. But this is it's an inexact science. So I'm firmly in the camp of what we are doing right now is providing a lot of support. Once we've actually seen substantial further progress, which is the forward guidance that we've given, to get back to our dual mandate goals, that will be the time to consider changing it. I don't see any reason right now to change something that is working and providing support to the financial system and to the economy.
Interestingly, there's a $40 billion options bet that at Jackson Hole, Jay Powell will say something to change the market's perception of when you might taper. What would you say to that kind of timing in terms of when the markets might hear from you?
I'm not going to speculate on that. I'm sure there are multi-billion-dollar bets on all sorts of different things. Let the markets have their fun and make those bets. We are focused on returning to our dual mandate goals, getting back to maximum employment. And we've said we want to see substantial further progress. And today's jobs report, for all those people who've been saying, oh, my gosh, the Fed needs to normalize quantitative easing, today's jobs report is just an example of we have a long way to go. And let's not prematurely declare victory.
Does this change your forecast for what happens the rest of the year in terms of growth and employment?
I need to look at the details underneath the numbers, which I haven't obviously been able to do. My gut tells me no. I think I've been in the camp that it may take a few years before we get back to full or maximum employment, because we still have a deep hole. Remember, this 8, 9, 10 million number of Americans who ought to be working, who want to work, who are not working, that is still roughly like the Great Financial Crisis, the deepest part of the Great Financial Crisis. So yes, there are sectors of the economy that are doing great. There are sectors of the economy that have fully reopened. But we are basically in a labor market like we were in 2009. And it's going to take time. And I hope it doesn't, like I'm saying, I don't want it to take 10 years. Hopefully we can put this back together in a year or two. But I just don't want to declare victory prematurely.
I guess I got to ask you one more question before we go, and that is, everybody was predicting that we were going to get the Fed's inflation target met by the end of the year or sometime early next year. Do you think that could be off, that maybe it's going to be a little bit harder to pull prices up?
Well, I think mathematically it's not going to be that hard to do it because we had such low inflation readings more than a year ago, and those numbers are now rolling out of the math. So I think between energy prices and arithmetic, you're going to see a short-term pop. But just that short-term pop in inflation is not at all going to convince me that that actually means underlying inflation is back to 2% or above 2%. And that's what I'm really going to be focused on. And so we're going to look at, if you look at inflation expectations based on market-based measures, the inflation expectations for the next few years have ticked up, but they're basically where they were for the longer horizon. And so we have a lot of data that we need to look at to try to determine, is this just math, or is this actually underlying inflation that has ticked up? I do think it's going to take more time for underlying inflation to tick up, and I do think it's going to be tied to the labor market. I'll be very surprised if we think that underlying inflation is actually climbing back to 2% or above 2% when we still have millions and millions of Americans out of work who ought to be working and who ultimately will want to work.